Hey everyone, I hope you're having a tremendous summer. I'm wearing shades today because it's very sunny and bright outside, but you know, the housing market, it's not bright at all. In fact, the outlook, it's getting dimmer and dimmer. All right, folks, welcome back to another satirical episode on the housing markets and the economy. We'll talk about why I think the Fed has made the housing crisis worse and how the job market is looking a lot more difficult, yet nobody is talking about what people are going through in terms of the struggles, but I'll talk about it. Similar to last time, we'll talk about anything related to economics in plain, simple English, nothing too complicated to understand. Even teens will understand what I'm saying. Some of my commentary will be entertainment and parody. Look, people are very stressed when listening to this stuff. You need some entertainment. Okay, so one of the first things that we need to take a look at is this important, critical development. A record number of home buyers are backing out of housing deals that were supposed to close according to Redfin's latest report. Specifically, what's going on is that almost 56,000 home purchase agreements were canceled in the month of June, which is about 16% of homes that were under contract in that month. Can you believe that? That means 1 in 6 homes that were about to be purchased got those contracts scrapped. Now, the ironic thing is that the median housing price is quote unquote at a record level. You'll see this all over the news. The problem with this statistic, in my opinion, is that it's not a representative number. Fewer and fewer people are buying at this level, as we can see with so many people pulling out of housing deals. Inventory is staying on the market longer as a result, and sellers are forced to cut prices when they do sell. So if you're in the market for a home, continue to be patient. So even though the median housing price is high on paper, when it's actually time to transact and do the selling process, many sellers are finding that they have to sell below ask. Let me show you what I mean. Let me show you this table. We can see that the share of for sale homes with a price drop is at 20%. This is 5% greater than it was last year. That's a pretty sizable percentage. The share of homes that are selling above their asking price, which is what the media makes it feel like is going on, is only about 35%. Guys, this is 5% lower than it was last year. Last year was 40%. When you add in all these stats together, it makes the rising median home price a rather unreliable proxy to whether homeowners can actually sell their homes at the price they think they should command if they were to list their property. Everything is really location dependent right now, and buyers are choosy. One of the biggest wild cards that is set to happen later this year is the much anticipated Fed pivot, where the Fed is going to start cutting interest rates. This will cause the mortgage rates to come down from their 7% levels today, but the reason behind the cuts is what is most important to pay attention to. The Fed isn't just cutting rates because inflation is drifting back towards 2%. That's too simple of a story. I think it's because they've spotted a serious problem that's been building up in the job market. The unemployment rate at 4.1% may not seem like a lot, but it's happening during a period where most of the jobs being created is by government spending and not the private sector. The trend is also going higher, and we may see this unemployment figure get bigger in the months ahead. So we need to be very careful. The real estate market is completely dependent on the job market, I think. You can see that in this chart here. If we strip out the government roles, the number of jobs being created on a monthly basis in the private sector will be cut in half, actually. This is important because it has a ripple effect on different types of people in our working population. Most college graduates, not all, are looking for jobs in the private sector, not the public sector. MBA graduates are also most likely looking for jobs in the private sector. These are the white-collar workers that support the housing market and these high prices that we see today. In fact, you probably work in the private sector, so as you can see, the private sector is very important. Now, the private sector, though, is hiring less than expected right now, and we can see this in the monthly private sector ADP jobs report that comes out. ADP job figures are starting to miss expectations, and previous month's jobs figures are also being revised lower. The chief economist at ADP said that if it weren't for leisure and hospitality, which are mostly part-time jobs, by the way, the data would be considered downbeat. The Fed is catching on to this, and this is why they're now telegraphing to the public that they're going to be potentially looking at their first rate cut in September. Previously, you may remember that the Fed was looking at only 1 cut for the entire year. Now they're back to pricing in 2 or even 3 for the rest of the year. If the job market were to weaken substantially, a lot is on the line for the housing market. So personally, I hope that the job market recovers because that's literally the backbone of our economy. Now, since we're on the topic of markets, I wanted to introduce you to today's video partner, Stockopedia, which is a very helpful platform for investment research of over 35,000 stocks across global markets. Every stock on the platform has a stock report page which shows key historical and forecasted financial statistics as well as industry comparisons to help investors understand the stock's investment potential. Stockopedia gives each stock a proprietary score based on fundamental principles like quality, value, and momentum. On their stock reports, you can see a comprehensive one-page summary of essential financial statistics, including historical and forecasted data powered by Refinitiv. The platform ranks winning styles and losing styles based on proprietary scores, which leads up to a final score on the stock rank. For example, Stockopedia labels NVIDIA as a high flyer, which is a category that means high quality and momentum, but lower on the value investing spectrum. My favorite feature on the platform is the Director Dealings tab, which allows me to see the insider corporate transactions that are taking place in one page. I'll get to see what the insiders are doing. The Major Shareholders tab is also a good resource as it shows trends in institutional ownership. The stock screening tool is also very helpful because you can screen for stocks that are still trading at reasonable multiples with strong growth rates to focus on capital preservation when markets are expensive. These tools are powerful to cut down on research time in a fast-moving market where a lot can happen in a short period of time. You can check out Stockopedia in my description below, which will entitle you to a 14-day free trial and 25% discount on any annual plan. You can also customize your plans and still receive the 25% discount by entering the discount LC25 at checkout. Okay, now back to the video. So what's clear here is that the Fed is cutting rates not because inflation is being controlled, but because they sense danger in the job market, and that could upend their plan to keep the labor market stable. One of the best ways to understand the labor market, I think, is through looking at the nuances of actual people going through this really difficult time. We find out a lot about how people are going through in the white-collar economy on Reddit. I want to share a couple examples. Honestly, many of us are so lucky, but not everyone is having a good right now, and sharing these anecdotes and stories from the Reddit forum helps us appreciate what we have. Now, a very common theme that I've been reading on the forum when it comes to finding a new job right now is that pay cuts are very, very common and should be expected. There was a commenter who talked about how they were a resume reviewer who worked with senior level professionals at the EVP, SVP, and C-suite level, and that many of them most likely need to see pay cuts in the $50,000 to $200,000 a year range if they're looking for a new job. A lot of other commenters have talked about how their pay has gone from $200,000 to $150,000 or from $150,000 to under $100,000 after going through a layoff and landing a new job. Some people who also work in tech and used to make $300,000 are now working jobs that pay $60,000. People have also talked about how they're withdrawing from their 401k to pay for daily living expenses. This is some serious stuff going on underneath the hood in our economy that we would only know about if we read about these anecdotes from forums. Another poster talked about how when a new job posting goes up on LinkedIn, these job posts have 500 applicants within 2 hours as well. And this is discouraging a lot of people from applying because of the crazy competition that everybody has to go through. Now, I know that this sounds terrible and it doesn't apply to all of us, but for a lot of people, this is real. This is a real challenge out there right now in the real economy. A lot of people are banking on the fact that rate cuts are going to be the magical cure that makes businesses hire again. I'm just not sure companies are going to be rapidly hiring again just because the Fed cuts interest rates a few times this year. Maybe the stock market will stabilize, but I'm unsure about the job market. What's more certain is that businesses are probably going to be more conservative with their hiring decisions, and them lowering rates will most likely not result in any serious demand coming off the sidelines to get into the housing market. So when you read about how when the Fed cuts rates, everybody's going to rush back into the housing markets, I don't think so, because the job market is in a situation of weakness. I think it will take a minimum 200, 300 basis points of cuts for the housing market to start looking attractive again when mortgage rates return to about 4% or so. Seeing the mortgage rates go from 7 to 6% won't do anything to help the affordability issue that is preventing first-time homeowners from even entering the market. The biggest hurdle for first-time homeowners is the massive down payment, and the Fed lowering rates modestly isn't enough to move the needle. Now, nationally for real estate prices, it will continue to be a state-by-state consideration. Up here in the Northeast, housing prices are still relatively stable. But in certain areas, say Florida, Texas, we're seeing the number of days on the market for existing homes for sale skyrocket from 30 days to 60 days. We're also seeing the number of homes for sale increase significantly with much more inventory on the market in those states. I'll get into more specific neighborhood data in the future, so make sure to subscribe when I get to them. So in certain pockets of the US, the housing market has already gone through a substantial correction. Whether we see real estate prices fall at the national level will come down to one focus point: how well the job market holds up. Now, I personally think that the job market will hold up and that there is starting to be a little bit too much pessimism about white-collar opportunities, but I think it's going to take quite some time for the job market to be robust again. So if you're in a tough situation right now, realize that you're not alone. Don't stop. You have to keep going. If you're in a favorable situation right now, help out others if you can. Be generous. Thomas Edison once said that many of life's failures are people who did not realize how close they were to success when they gave up. The Fed is going to cause so much more disruption in the real estate market and job market down the line, so we have to be ready for this. If you enjoyed the video, leave a like and subscribe here and on Substack. Thank you to Stockopedia for partnering with us today. Now, a famous author once said that success seems to be largely a matter of hanging on after others have let go. This will be an important line in the future.